In life, there's a fundamental principle known as cause and effect. When someone punishes you, the natural response is often to retaliate, especially if you have the means to do so. This concept doesn't just apply to individuals. It extends to entire nations as well. Take the current situation between the United States and China, for example. While the US has historically been able to exert its influence over smaller neighbors, its decision to impose a 10% tariff on China is now backfiring in a major way. This is no longer the China of the 1990s or even 2010. Today, China stands as the world's largest manufacturing and industrial powerhouse, outpacing the US in many economic areas. In this context, Trump's so-called four-dimensional chess strategy appears to be a significant miscalculation. Beijing recently announced a 10% tariff on cars imported from the United States, a move that will heavily impact American automakers like GM, Ford, and Mercedes. When combined with existing taxes, the total import tariff on heavy engine vehicles from the US will rise to 25%. This is a substantial blow. In fact, an additional 10% tax could effectively feel like a ban on US cars in the Chinese market. The challenges for American automakers don't end there. Manufacturing costs in the US are significantly higher than in China. Production expenses are steep, supply networks are costly, and electricity prices are far more expensive. Meanwhile, Chinese manufacturers have mastered automation technologies, allowing them to produce world-class vehicles, particularly electric vehicles, at a fraction of the cost of their Western counterparts. Trump's tariffs are not just a short-term obstacle. They threaten the future of the US auto industry. By imposing these taxes, he's limiting the revenue automakers depend on and straining the entire sector. Ironically, during his campaign, Trump warned US auto workers that without his leadership, the American auto industry would vanish within 2 to 3 years. He even predicted that China would dominate the electric vehicle market, leveraging resources and materials that the US lacks. Now, his policies may be accelerating that very outcome. While the US may have an abundance of gasoline, China's focus has shifted dramatically toward electric vehicles, rendering America's reliance on traditional fuel increasingly irrelevant. Trump's approach to this issue appears short-sighted, revealing a fundamental misunderstanding of the global transition in automotive production. This miscalculation is creating a significant dilemma for US workers. If exports to China decline, it will hurt business profits, setting off a domino effect that could ultimately cost jobs in the American auto industry. The stakes are high. In 2024 alone, US automakers like Ford and General Motors exported over $3 billion worth of vehicles to China. However, that market is now becoming increasingly closed off to American-made cars. China's automobile market, the largest in the world, saw more than 22 million vehicles sold last year, a scale no other country can match. Chinese consumers have a wealth of alternatives to choose from, including global brands with local production facilities and homegrown manufacturers like BYD and NIO, which are rapidly gaining market share at the expense of US brands. If American cars are excluded from China's market, consumers there are unlikely to notice. The real pain will be felt by US automakers like Ford, which is already grappling with quality issues and declining stock prices. The company's earnings are projected to fall by at least $2 billion in 2025, and its stock price dropped 19% last year. China's new tariffs on US cars will further squeeze profit margins, potentially leading to reduced exports or even financial losses. While Beijing's policies are putting pressure on US businesses, the impact on China's local economy may be minimal. The country's robust domestic market and thriving automotive industry mean it can absorb the fallout far more easily than the US can. In this high-as-takes game, it's clear that the US auto industry is facing a precarious future, one that demands a more strategic and forward-thinking approach. Instead, the current trajectory is likely to harm US manufacturing. While the US has been preoccupied with global conflicts, China has quietly strengthened its industrial capacity and fortified its economy against tariffs. Today, Chinese automakers account for 32% of global vehicle production, while the US contributes just 11%. The reality is that no country can afford to exclude China from the equation when it comes to affordable vehicle production. To produce cost-effective cars, access to Chinese manufacturing is essential. In the end, Trump's policies have inadvertently paved the way for China to solidify its dominance in global auto manufacturing. China's tariffs on US liquefied natural gas and coal were only the beginning. Its strategic moves on essential minerals, coupled with the new vehicle tax, demonstrate a calculated retaliation, and it's clear that this conflict is far from over. Let's take a moment to review recent developments. Just 2 days ago, Donald Trump imposed a 25% global steel tariff on all exporters worldwide. This affects major steel-producing countries like Japan, Canada, and Germany, which sell steel to the United States. But the critical question is, who actually bears the cost of these tariffs? The burden ultimately falls on the customer, or more specifically, the importer, which in this case is the US itself. This means cars in the US are about to become significantly more expensive, with hundreds of dollars added to the cost of each vehicle. Here's why. Steel imports into the US exceed $23 billion annually. With the new tariffs, US importers will pay 25% more for steel. China has been biding its time, waiting for Trump to make a misstep before striking back. And now, they've set their sights on the US car industry. Will American automakers disappear entirely? Not likely, but they will increasingly be forced to focus solely on the domestic market. Trump's strategy heavily prioritized generating revenue from tariffs while neglecting to strengthen and expand U.S. supply chains. The order of operations here is fundamentally flawed, and the fallout is becoming clear. This isn't just a U.S. problem. All major Western countries have made similar mistakes, and China has seized the opportunity. In less than 4 years, China's car exports have surged from near the bottom of the pack to the top, skyrocketing from under 1 million vehicles per year to nearly 5 million. In contrast, the US exported only about 900,000 cars last year. With the new tariffs in place, US car exports are expected to plummet even further. During Trump's tariff negotiations with the EU, one of his key arguments was that Europeans weren't buying enough Fords and Chevys, while American roads were filled with Mercedes and BMWs. The issue, however, is straightforward. U.S. cars aren't known for being the most fuel-efficient or highest-quality options. With the added tariffs, they'll become even more expensive. Even if the EU reduces tariffs on U.S. cars, they'll still struggle to compete with the affordability and quality of German-made vehicles. The real losers in this scenario are U.S. consumers. In any trade war, it's the buyers who end up paying the price. As shocking as it may sound, car prices in the U.S. are about to rise, and not just by a little. A 25% steel tariff could add as much as $1,500 to the cost of a vehicle, equivalent to a month's worth of savings for many American households. On top of that, domestic steel prices may rise even higher than the 25% increase, further driving up costs. It's like buying a cup of coffee. If the price of beans goes up by 50 cents, the cafe will still charge you $1 more. The financial strain doesn't stop at the sticker price of a new car. Inflation has already made car ownership more expensive across the board. Used car prices are up 40%. Maintenance and repair costs have risen by 30%. And car insurance premiums have increased by 29%. Even something as simple as replacing a gasket now costs at least 20% more. The trade war is squeezing household budgets. And as consumers feel the pinch, U.S. manufacturers will suffer too. Declining sales will only add to the industry's challenges. I have nothing against American-made products, but is it really a win if we're paying more for the same thing? We're living in a situation where either Trump is playing an extremely complex game, or he's pulled a terrible trick on American consumers. Either way, the consequences are clear. Tighter budgets, higher costs, and a struggling auto industry. It's a lose-lose scenario, and in the end, everyone pays the price. I could say that's all the damage, but that wouldn't paint the full picture. The escalation could easily continue in the weeks ahead. Trump is unpredictable, and we can't rule out further moves. What if he reimposes tariffs on Mexico and Canada? We know that Ford and General Motors produce a significant number of vehicles in both countries, and cars made there that return to the U.S. could face penalties. While more cars might be produced domestically, prices would skyrocket. Think that can't happen? Remember, this is Trump we're talking about. Anything is possible. Campaigning may be exciting, but it's not necessarily good for the global economy, or even the U.S. economy. A 25% tariff on a $25,000 car could add over $6,000 to the price, and manufacturers will inevitably raise prices to compensate. This isn't good for consumers, and will ultimately lead to lower revenues for U.S. automakers. How can they possibly compete with China under these conditions? Even as we speak, China's BYD is offering free smart driving systems and exploring AI integration in their vehicles. To pull off such innovations, you need market share, stable finances, and low manufacturing costs. something Chinese automakers have mastered. This trend will only widen the gap between Chinese and Western automakers. Trump's trade war is a classic example of focusing too much on the immediate gains from tariffs while ignoring the broader, more damaging consequences. The real harm comes from the second and third order effects, many of which we can't even predict yet. So buckle up, because this ride isn't over. What do you think? How big will China's retaliation be against US automakers? Will this push Trump to reconsider his trade strategy? Let me know in the comments below, and don't forget to like and subscribe as we navigate these turbulent times. Stay safe, and I'll see you next time. Thanks for watching.